$4.37. That is what a gallon of gas costs on average in the northeastern United States today. Last year, during the same stretch of spring, gas stations saw a surge, a 6% jump in demand as the weather turned warm and families escaped winter's grip. This year, demand didn't climb. It fell, down by 4.3%. That is not a rounding error. That is not a blip in the data. That is the sound of millions of drivers making a decision, quietly but unmistakably, to change the way they live. Not because they want to, but because they have to. The numbers don't lie. Between February and March, across more than 23,000 gas stations, Americans simply stopped buying as much fuel. And buried inside this simple statistic is a story about war, about markets, about the invisible levers that determine who can afford to move and who is forced to stay put. The question that won't let go is this: how did an oil shock half a world away translate so quickly into American families canceling trips, skipping visits, and rationing every dollar? And what happens when the buffer runs out? It is tempting to look away, to downplay what is happening in the hope that the pain will be temporary, that the world will adjust. Even seasoned traders, people whose entire careers depend on reading the signals before anyone else, have started to whisper that the real impact is too awful to truly price in. 1 billion barrels of lost supply. That is double the amount governments released in emergency reserves when the conflict began. The Strait of Hormuz, the world's most vital oil channel, remains choked in its 9th week of closure. Every day it stays shut, the supply gap widens. At first, the pain was felt in distant sectors, petrochemical plants in Asia, shipping lines recalculating routes. Now, with each passing week, that pain is spreading to everyday life, to the cost of filling a tank, to the price of food, to the jobs that depend on mobility. The adjustment is not voluntary. It is forced, either by prices that are simply too high or by governments that begin to intervene, ration, and restrict. If questions like this one are the kind you find yourself turning over long after the story ends, you are exactly the audience this work is made for. Subscribing takes 1 second, and it means the next story finds you. And when you are done here, leave a thought in the comments. The conversation that happens there is often the most interesting part. Before the shock, American consumers had come to see gasoline as a right, not a privilege. Oil flowed as predictably as the tides. Infrastructure, global alliances, and the promise of open seas made it possible to commute, to travel, to expect that the price at the pump would stay within the bounds of memory. Policymakers spoke of energy security as something already achieved. The system felt resilient. When crises struck abroad, the American market was supposed to be insulated, protected by geography, domestic production, and a web of international agreements. The prevailing assumption was simple. Disruptions might raise prices, but they would not reach the level of necessity. Gas was always available. The idea that drivers might voluntarily cut consumption or that families might cancel plans because the cost had become impossible seemed unthinkable. That assumption was wrong. What no one in the room had accounted for was already in motion. The first signals were easy to dismiss. Traders noticed a tightening in the futures market. Tanker traffic slowed through the Strait of Hormuz, but oil still found its way to ports at a cost. In the early days of the conflict, governments tapped into emergency reserves, releasing hundreds of millions of barrels to cushion the blow. Prices at the pump spiked, but then seemed to stabilize. The consensus was that these measures would buy time until normal flows resumed. But as the weeks stretched into months, the buffers began to erode. By the end of March, inventories had been drawn down to levels that made every additional barrel matter. In the background, U.S. energy exports surged as buyers around the world scrambled for alternatives. American producers booked record profits, shipping crude to Europe and Asia at a pace not seen in years. But inside the United States, the story was different. Gas prices remained high, so high that for the first time in a generation, demand began to fall during spring. Looking at the data, a 5% drop in gas purchases in a single month is not just a statistic. It is a rupture in the rhythm of American life. For the retail industry, for the hospitality sector, for every business that relies on people being able to move, this is an early warning. The window was closing faster than anyone realized. What came next would prove that everything the analysts had assumed about this situation was built on a foundation that was already crumbling. At 8 a.m. April 2nd, the Financial Times published a report that sent a chill through the boardrooms of the nation's largest retailers. In the Northeast, where spring usually brings a surge of travel, gas station sales had fallen to their lowest level since the recession of 2008. 12 minutes later, Bloomberg analysts confirmed what many had privately feared. The billion-barrel Hormuz oil shock was no longer a distant threat. It was here. Goldman Sachs followed with an internal note. 10,000 jobs could be lost each month through the end of the year as the shock rippled through the economy. Not layoffs at first, but a freeze. Companies holding back on hiring, bracing for a wave of reduced consumer spending. The unemployment rate, projected to climb to 4.6% by the third quarter, was only the start. By noon, gas stations in California reported average prices of $6.79 per gallon. In Los Angeles, some stations posted numbers above $7. For millions, the math became impossible. The cost to fill a tank outstripped weekly budgets. Credit card debt spiked as families tried to maintain routines. The decision to skip a trip was no longer a choice. It was a necessity. Each act of restraint became a data point. A canceled visit, a postponed vacation, a job not taken because the commute was too expensive. The pain was not distributed evenly. The poorest families, those with the fewest options, bore the brunt. For them, the oil shock meant more than inconvenience. It meant hunger. It meant deciding between groceries and gasoline. By the end of the first week, the cascade had begun. Airlines raised prices as jet fuel costs soared. Bookings fell. Hotels saw cancellations. The hospitality sector, which had barely recovered from the scars of the pandemic, faced a new round of uncertainty. Every domino that fell made the recovery harder to sustain. The S&P 500, driven by the runaway success of AI stocks and a handful of blockbuster IPOs, seemed to defy gravity. On paper, the economy was resilient, but beneath the surface, the cracks were spreading. Electricity bills climbed as power demand surged, not because of new industry, but because of data centers. The headline numbers, the ones that shaped the political narrative, became disconnected from the lived reality on the ground. The trap had been set weeks earlier. In the pursuit of energy dominance, American oil exports soared as Middle Eastern supply shrank. On the surface, this looked like a victory for U.S. producers, a chance to capture market share, to increase influence, to profit from scarcity. But the pie itself was shrinking. The bet was that the rest of the world would suffer more than the United States. That bet hit a deeper vulnerability. The U.S. economy, dependent on a global network of supply lines, was never as insulated as policymakers imagined. The cost of holding on to hegemony was paid not by executives or shareholders, but by ordinary people at the pump, in the grocery store, at the end of a long day spent trying to make ends meet. That single decision set off a chain of events that most observers still have not fully mapped, and the consequences are still unfolding today. The breaking point arrived quietly. There was no dramatic announcement, no sudden crash. Instead, the damage accumulated in millions of small decisions. At 6:15 p.m. on April 9th, the Bureau of Labor Statistics released new data. Job growth had slowed to its lowest rate in 2 years. Unemployment ticked up, inch by inch, as sectors dependent on consumer movement began to shed positions. Airlines cut routes. Trucking firms idled fleets. The ripple spread outward. Each reduction in gas consumption was mirrored by a loss somewhere else. A job, a contract, a business shuttered. Treasury officials watching the bond market scrambled to maintain confidence. Currency swap lines with Gulf states were extended, a maneuver designed to prevent a disorderly sell-off of U.S. treasuries. The front line was now the yield curve, a technical term that, in plain English, meant the cost of borrowing was rising. Every percentage point added billions to the national debt. The risk? a feedback loop where higher interest rates made everything more expensive, pushing more families to the brink. By the end of April, the full ledger began to emerge. Gas stations across the country reported revenue losses in the billions. Airlines projected a 17% decline in summer bookings. The retail sector, already battered by shifting consumer habits, braced for a wave of store closures. The government, forced to bail out budget airlines and negotiate financial support for Gulf allies, faced mounting criticism. The S&P 500 remained near record highs, but only because the gains were concentrated in a handful of companies. For most Americans, the economic recovery felt like a story told about someone else. The loss was not abstract. It was measured in canceled plans, in empty seats at the dinner table, in dreams deferred. What was made impossible was the belief that the system could absorb any shock, that resilience was guaranteed by geography or by policy. What was made inevitable was a new kind of vulnerability, one where the actions of distant actors, the closure of a single strait, could send ripples through every corner of daily life. The political consequences loomed as the 2024 election turned on questions of inflation, wages, and the contrast between past and present. The Secretary of the Treasury, defending bailouts and swap lines, found herself at the center of a storm, accused of protecting foreign interests while ordinary citizens struggled. The bond market became a battlefield, every movement in the yield curve a signal of confidence or panic. What this story exposes is the fragility that comes from complexity. The more interconnected the system, the harder it becomes to isolate a shock, to contain the damage. Power, when concentrated in the hands of a few, always carries with it the seeds of instability. The question worth sitting with is not whether this outcome was avoidable, but whether any of the actors involved had the incentive or the ability to prevent it. How do you weigh the interests of an empire against the lived experience of its citizens? Share what you think in the comments. The resonance of this kind of crisis is never limited to numbers on a page. It is measured in trust, in expectation, in the quiet recalibration of what is possible. And as the oil shock continues to ripple outward, the next chapter is already being written. In every decision, every adjustment, every new constraint that shapes the way we move through the world.